Mr. Big Short issues a dire warning about the economy. Michal Bury, a financial analyst who predicted the demise of subprime mortgages before the 2008 financial crisis, is concerned about the state of the economy. Burry foresees more speculation than in the 1920s, more overvaluation than in the 1990s, and more economic unrest than in the 1970s. Here are the shocking details on why Michal Bury thinks so. JP Morgan issued a warning. The US and world economy are once more in grave danger. Whether or not all economists believe that the US economy is starting to pick up steam is irrelevant. One thing is for certain, and that is that the stock market and economy are completely illogical and doomed for the foreseeable future. An international recession is becoming increasingly likely due to the negative or, in some cases, zero growth in corporate earnings. Recently, even JP Morgan issued a warning that the market may potentially decline by another 20% from its current levels. Stock prices have started to act unexpectedly due to recent sideways volatile movement. Some days see a severe decline followed by a recovery. Michal Bury is once again making a name for himself with his most recent precise prediction, while everyone else seems to be puzzled about the recession, stagflation, hyperinflation, or crash. He anticipated the subprime crisis before anyone else did due to his contrarian attitude. Michal Bury's most recent warning. According to Michal Bury, inflation will continue to worsen from here and will eliminate any market-to-market gains that people may have achieved over the past several years. Surprisingly, this is only the start. No bottom or end is in sight. The reasons behind the stock market sell-off and Michal Bury's most recent warning. Michal Bury cautioned investors not to get their hopes up about potential rallies in the upcoming winter quarter after analyzing the present trading situation. They won't lead to a market rebound because they're probably only temporary respites. A market rally is defined as a gain of the stock market of at least 5% in the midst of a downward trend. It's a typical practice during a down market. At least a 5% rally resulted from the bear market that lasted from 1901 to 2015. Two-thirds of the 21 markets were disrupted by rallies of 10% or more throughout that time. It seems clear that history is repeating itself in light of the current situation. Additionally, it is clear that the decline will be tougher to recover from the deeper it is. The Dow Jones increased by about 48% in 2019 after declining by 86% the year before. The dot-com market experienced 8 bear market rallies of 18% as well, with 4 gains of around 30%. However, before that, they fell even worse. Prior to reaching its bottom after a few years, the great financial crisis of 2008 experienced 9 bear market rallies, with gains ranging from 6 to 24%. Michal Bury said that since the market peaked on December 1st of last year, we've seen a pattern of declines of 8 to 10% followed by rallies of 5%, another decline of 8 to 10%, and then another 5% rebound. Michal Bury noticed that and tweeted, "Dead cat bounces are the most epic. 12 of the top 20 NASDAQ one-day rallies happened during the 78% drop from 2000's top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top." A temporary increase in stock prices following a severe decline is referred to as a dead cat bounce, frequently due to investors buying shares to cover their holdings. In a tweet, Burry noted that they frequently occur amid significant stock market falls. The implication is that investors shouldn't get too excited about any rallies that may occur in the upcoming months because they will probably be short-lived respites rather than the start of a market recovery. Burry pointed out that 9 of the S&P 500's 20 highest one-day rallies happened in the wake of the 1929 Great Crash, while 12 of the 20 biggest one-day rallies in the NASDAQ index occurred as the dot-com bubble burst. Burry said that the stock market could show several rallies before the crash is complete. He pointed out that the NASDAQ experienced 16 rallies of more than 10% following the collapse of the dot-com bubble, averaging gains of 23% each before experiencing a 78% loss at its lowest point. Burry further underlined that the Dow Jones Index experienced 10 rallies of more than 10%, each time gaining by an average of 23% after the Great Crash of 1929 until bottoming out at an 89% drop. The US stock market appears to be following the pattern of prior bubbles, putting it in a position for a catastrophic crash. The Scion CEO cited the S&P 500's recent 10-year trajectory, pointing out that it was remarkably similar to the index's chart for the decade preceding the dot-com crash and the Dow's trend for the 10-year period prior to the Great Crash of 1929. Burry claimed that history is repeating itself and that human nature was to blame for the continuous decade-long buildups. The major goal. When the VIX surged to all-time highs, as it did during the Great Recession in 2008 and 2009 and the pandemic's early stages in early 2020, it also roughly coincided with a market bottom. Similarly to this, the market peaked in late 2021 when the VIX was at a very low level. The VIX is currently around 32, indicating increased volatility. A VIX of 45 or higher hasn't, however, always indicated a bottom. The VIX was lower than it was current when the market bottomed out in late 2018. Therefore, it is possible, but economists were as worried about a recession at the time. Michal Bury also makes a few more criteria that are important to take into account when determining the stock market's bottom. He begins by noting that 13% of stocks closed above their 200-day moving average. Typically, when the percentage is closer to 5%, the absolute bottom occurs. Again, this was evident in both the years 2008 and 2009 and 2020. The dot-com crash, which was largely based on higher growth tech equities, is the single exception. In addition, he pointed out that 218 businesses with a combined value of more than $1 billion are losing $100 million annually. 29 businesses totaling $10 billion in value are also present. It's a market cap that isn't profitable. These businesses include, among many others, Uber, Snowflake, Lucid Rivian, and Shopify. If the current trend persists, we will see a similar pattern to that of the year 2008, when the market did not bottom for several more years. After that, inflation would continually increase, making matters worse. Michal Bury further says that the housing market would come under increased pressure as a result of this. It's the region where 1 in 10 homes is lowering prices at the fastest rate since 25. However, there is also good news. Now is a fantastic time to invest. The bullish market continued for more than 9 years with an increasing return of 476% if we exclude the average decline of less than 20%. However, if we factor in the 20% drops that appear to be trivial along the way, the average bull market still lasts for an average of 4 years with snowballing returns of 102.9%. We're approaching a bear market rally, according to a Wall Street Journal article. Since 1990, it's been noticed that the biggest recoveries occur following the worst declines. It does not, however, imply that the upcoming bull market will extend for 2 years. This is due to the fact that starting in the year 1940, the dot-com crash was followed by the bull market with the shortest duration. The market peaked at this time, rising up to 21% over the ensuing 3.5 months, before falling 34% over the subsequent 9 months. Then, during the Great Recession, there was a time frame of a month and a half during which stock prices increased by 24%, before dropping by 27% a few months later. Although it's well acknowledged that bull markets persist longer than bear markets, these levels of volatility are typical. It's common to witness 20% changes, both positive and negative. Additionally, it's been observed that during a bull market, equities increase by 114% while losing up to 36% during a down market. In terms of what Burry is doing, yes. He tweeted, "Another feeling I'm getting is mid-late 2000s, he said. Free cash flow totally on sale and ignored, while former momentum stocks are coming down but not far enough, and darling, better businesses still had a way to fall. Value was about to take off for years despite more crashes on the way. Inflation is expected to decrease, or people are spending more money. Builders are becoming more and more assured. Because of this, use caution in such a market and prepare for the worst. But don't base your investment strategy on the assumption that it might or might not occur. Increasingly, people are losing money and preparing for the impending crisis, which has become more common. Compared to individuals who often make dollar-cost average purchases without considering the consequences. The major goal must be to find strategies to significantly improve your revenue over the next 1 to 2 years. You have enough money to benefit from decreasing pricing even if the market declines." We've reached the end of today's video, but if you want to learn more about what Michal Bury says, you'll probably want to check this one out too. See you in the next video.